In our last video, we said that with $500, you can control a substantial amount of funds in the FX market. We're going to explain now how you can do that. Usually, if something costs 10,000 euro, you'll need to pay 10,000 euro for it. That's common sense. But in FX, you don't have to have the whole price of what you're buying. You only have to deposit enough money to cover possible losses. The deposit you put up is called margin. The broker then lets you trade a certain multiple of that margin. That frees up your money to put on more trades and allows you to make bigger returns relative to the amount invested. For example, let's say you want to buy $10,000 of Euro USD. You could, of course, deposit $10,000 and change it all into euros. But with margin trading, if you choose 1 to 10 leverage, you only have to put up 1/10 of the total amount as margin. That would be $1,000. 1 to 100 leverage means you only put up 1/100th or $100 of margin. And with 1 to 500 leverage, the most available, only $20. So with $20 margin, you can trade as if you had actually invested $10,000. The advantage to this is that you get a much higher return on your capital. Let's say you buy one mini lot of Euro USD for $10,000, which is currently trading at 135. Let's say Euro USD goes to 136. For every dollar you've invested, you'll make 1 cent. So that's 10,000 cents or $100. If you put up the whole $10,000, then your $100 profit would be 1%. But if you only put $20 margin to begin with, then your profit would be 500%. That's much higher relative to the amount invested. That's why it's called leverage. A small movement in your position makes for a big movement in your profit or loss statement. Of course, leverage works both ways. In this example, if Euro USD declines to 134.80, your margin would all be used up and your position would automatically be closed. You'll lose all your money that you put up as margin. But the good thing is, you can't lose any more than your margin to begin with. Your losses are limited while your potential profits are unlimited. Furthermore, if you had $500 in your account to start with, after opening that position, you'd still have $480 left to enter new positions. You could put on trades in other currency pairs as well, increasing your chances of success. Without leverage, a trader would need to post the full value of each of his trades. Leverage allows a trader to take the same position with much less capital and to earn a higher percentage return on that capital. Of course, it works both ways. The more leverage, the less room for error there is.